Light Auto beat Q2 revenue consensus, but they missed on EPS and just massively missed Q3 guidance.
Yeah, it was a rough print.
Revenue hit 25.7 billion RMB, which, topped the 25.07 billion estimate.
Right.
But adjusted EPS came in at a loss of 1.49 RMB per share. So missing the 1.47 loss expected.
And the real shocker was that Q3 revenue guidance.
Right, just 26.6 to 28 billion RMB.
I mean, that is miles below Wall Street's 32.28 billion mark.
Yeah, so the stock immediately slid toward a 52-week low near 11.65.
And Bernstein saw Gen cut their price target to 14.50.
Yeah. So we're taking a deep dive into the earnings call transcripts, analyst notes, and financial statements to figure out what went wrong. Because our mission today is to understand how a top-tier EV maker can beat top-line estimates, yet still trigger a massive sell-off.
Yeah, it's fascinating.
Think about it like running a premium steakhouse.
Okay.
Your books solid every single night, but you're actually bleeding cash because the wholesale cost of beef skyrocketed.
Right.
And suddenly, all your diners are exclusively ordering the cheapest side salads on the menu.
Yeah, I mean, that's a great way to picture the dynamic. Though obviously we're looking at an assembly line here, not a kitchen.
Fair enough.
But what we are seeing is that the market, frankly, doesn't care about sheer volume if the unit economics beneath that volume are actively deteriorating.
Right. Generating high revenue doesn't keep the lights on if the cars cost too much to build.
Exactly. Let's look at those unit economics then, because the segment performance tells the real story.
Yeah, Q2 deliveries actually fell 11.5% year over year.
Down to 98,330 units.
Right, but it's the vehicle margin that really stands out. It completely cratered to 9.4%.
Wow.
Yeah, down from 19.4% just a year ago.
So it's just cut in half.
Right. And that dragged overall gross margins down to 11% and drove a 1.7 billion RMB net loss.
Yeah.
Why such a drastic collapse in just 12 months?
Well, it's a toxic mix of two things. You've got product mix and elevated bill of material costs, or what we call BOM.
Right, BOM.
First, consumer preference is shifting. In this tighter macroeconomic environment, buyers are pivoting hard away from the luxury trims.
Right, and toward Li Auto's more affordable entry-level models.
Exactly. And those cheaper models naturally carry much thinner margins.
Makes sense.
Second, the raw materials required to build those cars, specifically the battery components this quarter,
Yeah.
they cost them more to procure than they initially forecasted.
Oh, I see. So when your input costs go up,
Right.
but your customers are simultaneously trading down to cheaper vehicles.
Your margin profile just gets squeezed from both ends.
Yeah, that is rough. So how is management planning to stop the bleeding?
Well, looking through the commentary, CEO Shang Li is flat out refusing to pass these higher BAM costs on to consumers.
To preserve market share, I assume.
Exactly. Instead, he's betting heavily on vertical integration, specifically developing their own in-house battery technology to absorb the pressure.
Wow, which is a massive, capital-intensive gamble.
It is. I mean, by moving battery production in-house rather than buying from external suppliers, Li Auto theoretically cuts out the middleman's profit margin.
Right.
They gain tighter control over their supply chain, and they can optimize the battery design specifically for their own chassis.
But building battery plants takes years and immense upfront capital.
Right. It's a long-term structural fix being applied to a very short-term profitability crisis.
Yeah. And while the CEO is looking at the long term, CFO Tai Lai is trying to reassure the street right now.
Yeah, he's predicting margin expansion in the back half of the year.
Claiming they'll see a shift back to higher-end trims like the Livis, plus a volume boost from the upcoming Mega L9 and i9 models.
Right.
But I have to challenge this math. They were guiding for 95,000 to 100,000 deliveries in Q3.
Yeah.
Didn't they start the year projecting around 490,000 deliveries for 2026?
They did. That initial guidance implied a 20% annual volume growth.
Then if Q3 only hits 100,000 units, the delivery curve required in Q4 to actually hit that 490,000 annual target is completely parabolic.
Oh, absolutely. We're talking about an unprecedented step up in factory output and sales in a single 90-day window.
It requires absolute flawless execution across the board.
And right now, the environment is incredibly hostile to flawless execution.
Yeah.
To your point on production, autoscaling isn't just turning a dial up to maximum. You need your entire supply chain to match your pace perfectly.
Which simply isn't happening. I mean, looking at their July production data, a simple headlight shortage cut production of the i6 model by 4,000 units.
Oh, wow.
You can achieve a parabolic Q4 delivery curve if a single missing component halts the entire assembly line.
Exactly. Supply chain fragility is a constant threat. But, the internal threats might actually be worse than the missing headlights.
Wait, really?
Yeah, look at that upcoming product slate that CFO was banking on. The Mega, the i9, and the L9.
Okay, they are all premium, family-oriented battery electric vehicles.
Yes, and they are targeting the exact same buyer demographic.
Oh.
So instead of capturing new market share, they're introducing massive cannibalization risk.
Because they are crowding their own showroom floor with overlapping products.
Exactly, right at the same moment. Competitors like Xiaomi and BMW are aggressively slashing prices to steal those exact same family buyers.
Wow. It's basically a zero-sum game in that premium segment right now, and Li Auto is fighting its own models as much as the broader competition.
Yeah, it's brutal out there.
Well, navigating these brutal market dynamics is exactly why we do this analysis. For those tracking these stocks, make sure to follow along for our daily earnings coverage so you get these deep dives into the sources the moment the numbers drop.
I'll leave you with a final thought to chew on.
Okay.
We started by talking about that Pack Steakhouse losing cash.
Right.
If Li Auto is currently China's top-selling brand in the premium EV space,
Yeah.
with all their scale and brand power, and they still posted a 1.7 billion RMB loss this quarter.
Right.
What does this vicious price war mean for the survival of the smaller, unscaled EV manufacturers who can't even get customers in the door?
Man, that is a scary thought.